Hello and welcome to NAAIM Confidential, where we interview investment managers and discuss their approach and outlook. Today is episode 15, and I have the pleasure of introducing our next guest, Henry Rohlfs. Henry is the vice president of Halbert Wealth Management, a registered investment advisor firm in Austin, Texas. He holds a degree in biophysics from the University of California at Davis. In addition, Henry is also the technical director of Theta Research, an investment performance verification company, which we're very familiar with at NAAIM. Fun fact, Henry is also a musician, a former band and orchestra director, and occasionally plays the trumpet with local groups. So welcome, Henry. Thank you for joining us.
Well, thank you, Ben. It's a pleasure to be here.
Yes, it is. Yes. And after this, it's been a crazy week too. So we're going to have a lot to talk about. I always want to start off giving a brief description of the NAAIM exposure index and just looking at that. So I'm going to share my screen here. So NAAIM exposure index represents the average exposure to U.S. equities across all of our members. We have seen a big decline from last week. Last week it was at 84.24. This week we are down to 62.98. We've seen what's been going on with the market this week. It's definitely better to be a little bit lower exposed. And we've seen a pretty big decline from 2 weeks ago. We were all the way up above 100% at 103.88 2 weeks ago. So we've had quite a steep decline there in the last few weeks. And I always like to go down here too. We still have, on the extreme side, we have some members, at least a member that is fully inverse, and at least another member who is also fully bullish still at this time. But the average comes out to 62.98. Henry, what are your thoughts on the decline over the past week with this exposure?
It amazes me that the market is reacting so strongly to the Fed saying that they're not going to cut rates anytime soon. The FOMC's been broadcasting this pretty consistently since the first of the year. I don't know if it's just that. I also saw that there were quite a few pretty popular tech stocks in the last couple of days have taken it in the shorts. SMC was one, NVIDIA is another one. So I think in large part, we're seeing a big pullback, at least in the tech sector. And that's probably what's mitigating quite a few of the issues that we're seeing right now.
Definitely. And usually when we see a decline, especially like this, it could be a couple of things that can be leading to it. I know with today, with everything going on with Iran, is that playing a role in there as well? What about next week? What do you see? What do you foresee for the next few weeks? Do you have any ideas?
Well, let's see. Do you have a dartboard handy? It's really tough to tell right now. We were just talking earlier in the office, and all we can do is say, let's wait and see what happens next week. At this point, it's really hard to make a prediction. It's been so volatile that there's no trend established. So we're just gonna have to wait and see.
Right. Oh yeah. No, it's definitely going to be interesting. And if you're following the NAAIM Confidential each week, you'll get thoughts as they're happening week by week by all of our members. I also want to talk a little bit about the Uncommon Knowledge Conference that we have coming up just around the corner here, April 28th through May 1st, down there in Orlando, Florida. So we're just looking at here, we got a couple speakers, ChatGPT. Today's opportunity is about active management, cybersecurity, Bitcoin's in there. You can kind of look at the list. If any of that intrigues you and you haven't signed up, I'd say sign up. I've been there plenty of times, and every time I walk away with a vast number of knowledge. And Henry, I know you've been there a couple of times too. Are you going this year?
Oh, definitely. Yeah, I will definitely be there. It's a great chance to get to catch up with friends, first off, but the sessions look great. I really enjoyed listening to Tom Giacchetti with Stark and Stark. He tells us what's happening at the SEC, and it's always valuable information for me to bring back, as well as, of course, the information on marketing that's shared, and also on what's happening in the markets.
Definitely. I have notes that I'll write down from each conference, and then I'll stash them away and I'll look at them 4 or 5 months later. And it's crazy just seeing all of the knowledge that I've forgotten since then. So if you go there, you're going to get a lot of knowledge. Make sure you write it down, store it somewhere, because, any conference you go to, you can get kind of that water hose information, and then you don't retain as much after about a week or two. But there's a lot of knowledge there, so you definitely want to take notes and revisit it. So next up, let's talk a little bit about your investment philosophy. I know you have some slides to share and a little bit about Halbert Wealth, so let's jump into that.
Well, that sounds great, Ben. Let me go ahead and share my screen as well here, so that we can take a look at these slides. That should pop up here in a sec. Halbert Wealth Management is a little bit different than many of the managers who have been on NAAIM Confidential before. I know I've watched the sessions, and I'm really impressed with the level of knowledge and expertise that these members have shared. It's pretty humbling for somebody like me. I'm not a market technician like many are, but instead, in fact, I was talking with Ben earlier, and I said, I don't know that I have anything to share. And then I got to thinking about it, and I said, you know what? Why don't we just talk about what Halbert's investment philosophy is, since it is a little bit different. We're in a very different space. First of all, what we like to say is that our main goal is to create legacy wealth by investing like an institution. And that's what I'm going to share with a little bit about today, is what we think about that and how we actually do that. If I can, there we go. Our mission statement is to strive to help our clients know the peace, the security, and satisfaction of achieving legacy wealth. Now, legacy wealth means different things to different clients. For some, it may be to help pay for education. For others, maybe a down payment on a home, or providing financial security for their family, especially these days where we're seeing longevity go well into the 90s. That's an important thing, to have that long-term financial security, but also to pass wealth to future generations. And so what we have done for years is try to find ways to take care of those goals that our clients have. And the way that we've done that is to design portfolios to invest like an institution does. Now, what do I mean by an institution? I'm sure many of you are familiar with the very large endowments for universities, and that's kind of what we started to base this on. And that's what I'm going to share with you today, is actually from a white paper that we put together years ago that talks about how institutions invest and how a retail investor can do the same thing these days. So how is it that institutions invest? Well, first off, they have a diversified portfolio. Of course, financial advisors always encourage investors to diversify, but it's how the institutions diversify that's really interesting. The first one is they're designed to limit losses. Now, something that I know has been shared in other NAAIM Confidential sessions, as well as I'm sure webinars to our investors or money managers have been to, that it talks about the importance of limiting losses. And that's been a philosophy of Halbert Wealth Management for a very long time. I'm sure everybody's familiar with the concept that if you lose 50% in a portfolio, it takes 100% to get back to even. And so limiting losses is an important thing. And that's one of the ways that institutions design their portfolios, is to try to limit losses. Something that we thought was really interesting is that they've substantially lowered exposure to fixed income and also to domestic equities as well. We'll see that in a minute. But the thing that really stood out to us is that over 50% of the portfolios in these large institutions were in alternative assets. Now, we've been dealing with, in the alternative space, since the 70s, actually. And so it was a space that we were familiar with, And what we found is that people, especially in the last several years, are now more open to alternative assets. And there are alternatives that are now priced in a way that a retail investor can participate in them. This is a chart that we put together to show four of the largest endowments and how they are actually invested, how the portfolio is aligned. All this is public information. For instance, Harvard, all of these every year will put out a white paper that explains their investment policy, as well as showing what sorts of assets they're invested in. And if you compare that on the far right to the usual 60-40 traditional, there we go. I'm going to get a laser pointer here. The 60-40 traditional portfolio that we're all familiar with of equities and fixed income, you can see that these endowments are very differently apportioned. If you look down here in the green section, you can see that the fixed income part of the portfolio is considerably smaller than what's traditional. And the same goes for domestic equities, incredibly small as compared to what people traditionally think about a properly allocated portfolio should look like. But if you look in the center of these bars, in the blue and the golden sections, you'll see that there's a large percentage invested in private equity and absolute return strategies. And this was something that was really interesting to us because we've been involved in that space, as I'm sure many of the NAAIM members are as well, this is something that has really gained popularity, and it shows that it's a viable way to set up a portfolio. In fact, in Yale's investment philosophy, they actually write that the heavy allocation to non-traditional asset classes stems from their return potential and their diversifying power. Today's actual and target portfolios have significantly higher expected returns and lower volatility. And that's one of the things that we've also found by putting alternative assets into a portfolio, that the volatility tends to go down. We're limiting losses. So this is what we look for in alternative assets. We want to look for alts that have a low correlation to stocks and bonds. Many of our clients that come to us are professionals on the verge of retirement, or maybe they have recently retired, or they've sold a business, and they really want to limit losses. They're all about capital preservation. It's very important to them. They're really not looking to hit a home run, but instead they want to hold on to their capital and have some growth with it. Lower volatility over time, so they don't see the big swings up and down like the typical markets do. And then consistent absolute returns. Again, not trying to hit a home run, but to have steady returns. So the kinds of examples of investments that we tend to look at are private equity lending. That's a really big sector at this point. Real estate lending. We were heavily involved in real estate trusts for quite a while. I know that there have been some that have had a really tough go of it the last 18 months because of the commercial rental space. There's a lot of vacancies in commercial property at this point. But the real estate sectors for single and multifamily housing, that's a really great sector still. It's been very strong. Light industrial is another one that's held up quite well. But private credit has been one that we've seen, especially since last year with the tightening that traditional banks have had with lending. Higher rates, very strict lending requirements have caused the private lending sector, private credit, to really explode. In fact, recently we saw a private credit fund that is actually doing right around 10% yield annually, which is just phenomenal in that space. Insurance-linked assets, that's another one that we've been involved with for some time. Option strategies that use very long-term options, leaps. which can provide unlimited upside with a limit on downside. Of course, quantitative long-short strategies that I know many folks in NAAIM are very familiar with, and alternative fixed income. So these are the kinds of things that we look at and to encourage our clients to put in their portfolio. And we've been really happy with the way this goes.
So I do have a question.
Yeah, go ahead.
Regarding the charts from the like Yale and Harvard, the institutions over there, how closely do you align with some of the numbers that they have there? Are you trying to fit pretty closely on some of the averages that they have, or in just some areas?
Yeah, we do. We tend to see our clients a little more exposed to traditional equities. And I think that's more because they'll have accounts that are elsewhere, that they've had legacy accounts, maybe an old rollover from a 401k, something like that. But yeah, we typically do try to hit that 30-40% sweet spot for alternatives. Because it does tend to really balance out the portfolio. But one of the things that we have seen is, like the slide is, just to finish things out, is that retail investors can now invest like smart money institutions, is what we like to say. The alternatives that have been rolled out in the last several years have lower lockups. It was very typical for us to see 3 to 5 year locks several years ago. Now there are quite a few funds in that space that have 1 year lockup periods, or even what we call a soft lock, which is maybe a 2% surrender charge in the first year. Much lower minimums, some as low as $5,000 to $7,000. So the space is really, it has become quite interesting and very approachable for retail investors. But that's our philosophy, and that's where we're settled in at this point, and we really appreciate being in alternatives as long as we have.
Definitely. So that made me think, I'm not as familiar with the alternative side of thing, but is there any, with it being open to more retail investors, do you foresee any consequences with opening that up to a wider market in the future? Could that whole space kind of change with it having a blend now of more retail with institutional?
That's a great question. I don't think so. At least that's not what we've seen. And I know that the sponsors of these funds are actually pretty happy, because if you have an institutional investor make an extremely large placement and then they decide to rotate into another sector and they leave your fund, then that leaves them hanging. So having retail investors in the RIA space has actually been a positive thing for a lot of these funds. I was talking with a VP of one of our funds recently, and he said that there's such an interest in getting more RIA firms involved with their family of funds just for that very reason. It tends to stabilize their AUM.
Got it. No, I like that. That makes a lot of sense.
Oh, one other thing I will mention, that the chart that I showed was one from 2021. I did a real quick check on the 2023 numbers, and they're almost identical, off by maybe 1% or 2%.
Okay. No, that's also good to know. Definitely a little bit interesting with some of the markets, but I guess with a lot in the alternative space, the lower amount of change actually does make sense the more I think of it. And then, is there anything, did you have anything else to share, or is this just all of it for Halbert Wealth then?
That's about it there.
Okay. Perfect. Do you happen to have a favorite investment quote?
I do. Now, as you might be able to tell from my name, I'm very German. And as a German, I have learned to be tight with my money. And so I like to quote Benjamin Franklin. His original quote was, "A penny saved is 2 pence clear." Kind of old English. we all know it as a penny saved is a penny earned. And that was something I grew up with. But, in thinking about it, it really reflects the whole idea about limiting losses, which is a big tenet that we try to instill in our clients.
No, I like that. That's always one of my favorite parts is listening to the different quotes because those just stick in my mind. And I go back when I have to re-listen to these and pull some clips from them. The quotes are always ones that just like, oh yeah, I remember him saying that. And just gets me thinking about that concept again. So thank you for sharing. I know you had mentioned when we were talking before this, are you talking about theta research at all?
Yeah, so I know a lot of folks in NAAIM know me from Theta Research, which is a performance verification service. I'm going to be at Uncommon Knowledge next week. Would love to have folks stop by and say hello. Whether you're a subscriber or not, would love to meet you and get a chance to show you what we do. It's been a fun year. We've had some new managers come on board, which is great. I just was talking with a gentleman today, as a matter of fact, with a new model that he had just put together, new strategy. And so very exciting what's happening there.
Awesome. Yeah, at Scarecrow Trading, we're very familiar with theta research, but it's always nice to see more managers added to the list and just so you have more people to look at it and choose from when you're going there. What about contact information? So if anybody wanted to contact you regarding some of the stuff that you went over, they're like, hey, you know what? I like a lot about this institutional investing style. Can I learn more from you? Do you have some contact information for them?
Absolutely. You can go to halbertwealth.com, and right there on the homepage is a link that says how to click here to learn how to invest like an institution. And you can download our white paper and see the numbers that I showed today.
Perfect. Awesome. Well, thank you so much. Do you have any other thoughts or wisdom that you want to leave us with before we part ways?
Oh, gosh. I don't know about wisdom, but I I will say that drinking a glass of wine today makes the heart happy. And it's one thing. I live in the Texas wine country, and when I say that to a lot of folks, excuse me, they say, I didn't know that Texas had a wine country. So I'm very excited to share about that. And if you stop by and see me, there might be a bottle of or two of Texas wine floating around, and I'd be happy to share.
All right. Well, I will start booking my trip down there. So I will see you soon.
Yeah, I'd love to host you, Ben.
Well, I definitely do plan on making a trip down there as I have a little bit more time to travel. With life changes right now, it's not as much travel time, but it'll be around the corner for a lot of that. Well, once again, I want to thank you, Henry, for coming here and sharing your knowledge with us. And I think that's about it. We will catch everybody next week at the next episode of NAAIM Confidential. And I hope to see you there because, we're definitely in a very interesting time in the market right now. So each week, you're going to get a lot of insight with these changing market conditions. So definitely want to see you there.